Good afternoon. I want to welcome everyone participating in this afternoon's webinar co-hosted by GRF and FEA. My name is Alejandra Jensen, and I am a nonprofit audit manager at Gelman, Rosenberg Freedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what participants need to do to earn CPE credit for today's webinar. For the best sound quality, we highly recommend you connect by phone instead of your computer. If you have any technical questions or issues during the webinar, please use the Q&A function to speak with our webinar administrator for assistance. Technical assistance is also available from WebEx at the number shown here. Please note this webinar will be recorded and made available on our website following the event. The slides will also be posted at this address, www.grfcpa.com/webinars. Webinar participants seeking CPE credit for this presentation must complete and submit a short evaluation survey that you will receive via email containing the link to SurveyMonkey following the webinar. Please write down the CPE words when they are given. They will not be provided again. You'll be asked to recall these words in order to receive credit. Any technical questions about the survey may be addressed to Dominic Acosta at dacosta@grfcpa.com. As the title of the webinar implies, today's learning objective is to provide attendees with a better understanding of ASU 2014-09. One CPE credit is available to attendees of today's webinar. At this time, I would like to introduce Financial Executive Alliance's Event Coordinator, Caitlin Trillo.
Good morning and good afternoon, everyone. Just wanted to take a moment to introduce myself. I am Caitlin Trillo with the FEA, Financial Executives Alliance Event Coordinator. Thank you all for participating, and a special thanks to Gelman for co-hosting this webinar with us today, and I'll pass it back to Alejandra.
Thank you, Caitlin. With all that said, welcome to today's webinar, Changes to Recognizing Revenue with Implementation of ASU 2014-09. Is your nonprofit prepared? Co-hosted by Gelman, Rosenberg Freedman and Financial Executives Alliance. Today's speakers include Walter Derengowski, a nonprofit audit partner with over 15 years of public accounting experience with Gelman, Rosenberg Freedman, servicing the nonprofit sector exclusively. He manages audits for a wide variety of nonprofit clients like trade associations, charitable organizations, non-governmental organizations, private foundations, political action committees, and other similar institutions. Trevor Williams, also a nonprofit audit partner, has worked in public accounting for over 22 years. He has extensive experience with audit functions, contractual compliance rules, regulations, policies, procedures, and accounting operations. He is active in the firm's implementation of the latest Statement on Auditing Standards concerning the assessment and response to audit risk in a financial statement audit. With that said, I would like to introduce Walter Derengowski.
Thank you, Alejandra, and good afternoon and good morning for those listening in on the West Coast. Both Trevor and I are really excited and pleased that you are joining today's webinar. Our goal today is to introduce you to the guidance from the Financial Accounting Standards Board on accounting and reporting of revenue that is soon to be effective. The guidance is considered to be the most significant piece of guidance issued by the FASB in recent years. For some entities, the accounting changes will be minimal and only new disclosures will be required. However, for others, significant accounting and reporting changes will be needed in addition to those new disclosures. In our presentation, we will introduce you to the new guidance, including where it could be found, why the change, new requirements, and how they differ from existing GAAP, the effective dates, and how you might begin to implement. We will also follow up with an overview of the new project that arose from the new guidance regarding contributions received and contributions made. So where is the new guidance? The main principles of the guidance can be found in FASB ASU 2014-09, Revenue from Contracts with Customers, Topic 606, which was issued by the FASB back in May 2014. This was a culmination of over 6 years of deliberation between the FASB and the International Accounting Standards Board, IASB, and since that time, they have added 6 additional ASUs for a variety of reasons. First, they wanted to delay the original effective date by 1 year based on requests for additional time to implement. And then the remaining 5 ASUs, they wanted to clarify, modify, and improve some of the original guidance based on the feedback from the stakeholders. The guidance was placed in a new topic in the FASB Codification 606, Revenue from Contracts from Customers. This ASU does supersede most of the existing guidance that was in FASB ASC 605, Revenue Recognition, as well as many other selections of the codification. And just to be mindful, Topic 606 has over 700 pages of reading, and that doesn't include the additional 6 ASUs that have followed. So the big question is why? So for many entities, revenue is the single largest amount in their financial statements. So management, lenders, those charged with governance, stakeholders, and other financial statement users focus on revenue to monitor an entity's financial performance and general financial health. So trends in revenue from period to period are also important. Revenue is used in many financial ratios, debt covenants, and a basis for determining compensation and benefits, and on and on. So several years ago, FASB and IASB undertook a project to converge portions of U.S. GAAP and IFRS and selected revenue as one of the areas to pursue. Both of the boards identified weaknesses in their existing accounting guidance for revenue, and both boards recognized their existing disclosures requirements were not adequate to provide financial statement users with sufficient information to understand an entity's revenue. The objectives of the projects were to create a more robust framework for addressing revenue, simplifying financial statement presentation, improve comparability across entities and industries, remove the weaknesses and inconsistencies, and improve the usefulness of financial statements through those enhanced disclosures. So effective dates. For public entities, the effective dates start with the annual reporting period beginning after December 15th, 2017, including those interim reporting periods within the reporting period. So effectively, that means year ends December 31st, 2018 is the first to adopt. But let's take a minute and just look at what the definition of a public entity is, because that may impact some of the nonprofits. So the definition of a public entity is defined in the codification as a public business entity, first. Second, a nonprofit entity that it has issued or is a conduit bond obligor for securities traded, listed, or quoted on an exchange or over-the-counter market. And third, an employee benefit plan that files or furnishes financial statements to the SEC. So therefore, some nonprofits may have to go with this earlier implementation date, but for all others, including most nonprofits, the effective start dates with annual reporting periods beginning after December 15th, 2018. So what that effectively means, December 31st, 2019 will be the first to adopt within that category. Now I will turn it over to Alejandra to go through our first polling question and provide the first CPE word.
Thank you, Walt. So the first polling question is, what impact do you think Revenue 606 will have on your organization? A, it will have a major impact on my organization. B, it will impact my organization a little, but not greatly. C, it will not impact my organization in any noticeable way. D, I do not know yet. Please take a moment now to answer. While participants are recording their answers, I'll provide the first CPE word. The first CPE word is summer. If you want to receive CPE credit, please jot these words down because you will need them for the survey emailed following the webinar. Again, the first CPE word is summer, S-U-M-M-E-R. While the polling closes and we wait for the results to appear, GRF will be hosting a seminar July 19th for 1 CPE credit. Join GRF and Tabush Group for an interactive discussion led by recognized IT experts to learn what savvy organizations are doing to ensure they are protected while also streamlining their IT. You will come away with valuable insights and strategies to transform your organization and support your mission. With that said, I will pass it back to Walt.
Thank you, Alejandra. And the results came back, and it looks like the majority of the responses indicate that they do not know if this new ASU is going to affect their organization. So let's continue and see if it will impact your organization. Now let's go over what the new requirements are. Our current GAP uses a more rule-based approach to revenue recognition so that revenue can be recognized as certain rules were met. However, this new guidance utilizes a principle-based approach that often requires you to apply more judgment when considering certain matters, such as contract terms and other factors and circumstances. While Topic 606 attests to address the accounting for various contract terms found across multiple industries, it does not address every fact pattern that may be present in specific industries, including the nonprofits. Each industry will need to interpret and apply this principle-based guidance to their transaction. There are two key principles that apply when accounting for revenue. First, revenue should be recognized in a way that reflects the transfer of promised goods or services to customers. Thus, determining when a promised good or service is transferred to the customer is really a critical factor. And secondly, the amount of revenue recognized should equal the consideration to which an entity expects to be entitled for those promised goods or services. Determining the consideration in many transactions is not difficult because the amount is fixed and it will not change. However, in other transactions where variable consideration may be involved, are there multiple goods or services to be delivered? That determination could be much more challenging and require judgment. The core principle of the new standard is to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which that entity expects to be entitled in exchange for those goods and services. So, the new guidance applies to all entities regardless of industry that enter into contracts to provide goods or services to those customers in the ordinary course of business. Therefore, exchange transactions are subject to the new ASU. And the definition of an exchange transaction is a reciprocal transfer between two entities that results in one of the entities acquiring assets or services or satisfying liabilities by surrendering other assets or services, or incurring other obligations. And some examples of exchange transactions are membership fees, sales of products and services, naming rights, sponsorships, special events, grants and contracts, and of course there are others, but those are the most common that we see. There are many exchange transactions that have a contribution component attached, and therefore the organization will have to bifurcate those transactions in order to properly apply the new standard. This may cause considerable judgment, and Trevor in a later slide will give us some guidelines to help us go through that process. With this new ASU, it is important to note that non-reciprocal contributions do not follow the ASU. It does not specifically state that they are excluded within the guidance. However, by definition alone, so non-reciprocal contributions do not apply. FASB has acknowledged this, but is unwilling to document within the ASU. So the definition of a contribution is an unconditional transfer of cash or other assets to an entity, or a settlement or cancellation of liabilities in a voluntary non-reciprocal transfer by another entity acting other than as an owner. So the following contracts were explicitly excluded within the ASU, and those are lease contracts, insurance contracts, financial instruments, and other guarantees, and they all follow different guidance under other ASUs. So now let's talk about implementation options. The ASU requires a retrospective adoption using either a full retrospective for all prior periods or a modified retrospective type of adoption. Let's look at transition option number 1. So under this particular option, you apply retrospectively to each prior reporting periods presented and may elect any of the following practicable expedient. For a completed contract, you do not have to restate contracts that begin and end within the same annual reporting. For completed contracts having variable considerations, the entity may use the transaction price at the date of contract was completed versus trying to go back and estimating some type of variable consideration amount for those comparative reporting periods. And for all reporting periods presented before the date of initial application, entities do not have to disclose the amount of the transaction price allocated to remaining performance obligation and an explanation of when the entity expects to recognize the amount in revenue. So under option 2, this allows an entity to adopt the new guidance retrospectively with a cumulative effect of initially applying in the opening balance of net assets to date of initial application. The comparative periods presented would not be restated, so there is less work here involved. The rules apply to contracts that are incomplete at the date of initial application, and you must provide additional disclosures on how each line item in the current accounting period compared. And the last transition option under 3, which is going to be the easiest, is a single year financial statement for showing any type of comparative in the year of adoption. So with that, I will now turn it over to Trevor.
Thank you, Walt. The first thing I'd like to go over with you all is the 5-step model. And before we look more closely at each and do a deeper dive with all of the 5 steps, I just want to briefly go over each step. Step 1 is to identify the contract with the customer. Step 2, identify the performance obligations in the contract. Step 3, determine the transaction price. Step 4, allocate the transaction price to the performance obligations in the contract. And 5, recognize the revenue when or as the entity satisfies a performance obligation. So in doing our deeper dive with step 1, you'll see we are to identify a customer contract. And before I go into the definition of a contract, I'd like to briefly talk about what a customer is. A customer is a party that has contracted with the nonprofit organization to obtain goods and or services from that entity. A contract is an agreement between at least 2 parties that includes enforceable rights and obligations. And what's key here is that you will need to consider federal, state, and local law to determine which contracts are enforceable by law. And certain criteria must be met in this step to permit revenue recognition. And lastly, the contract does not always need to be in writing. A verbal and or an arrangement implied by your normal customary business practices can also constitute a contract. In step 2, you will identify the performance obligation. A performance obligation is a promise in a contract with a customer to transfer distinct goods or services to that customer. This concept is similar to the deliverables in our prior revenue standards. In the sales industry, the good is available for sale and the customer decides to purchase. And also in a service industry, the performance obligation may be a one-time or a continued service over a period of time. One of the key items here is that if multiple goods and services are part of the performance obligations, each good and or service should be separately identified from the other promises in the contract. If multiple goods or services are promised in a contract, then they may need to be combined into distinct bundles. Step 3, determine the transaction price. In short, it's the amount that will be ultimately recognized as revenue. The Accounting Standards Update defines the transaction price as the amount an entity expects to be entitled to for fulfilling its obligation to transfer the promised goods or services to a customer. This can be a fixed amount or it could be a variable amount or consideration. For example, any types of discounts, rebates, or other incentives. This amount does not include amounts collected on behalf of third parties. The transaction price is usually cash, but could also include non-cash items such as shares of stock. If, however, it's a variable or non-cash transaction price, judgment will be required to actually determine that transaction price. Consider the time value of money, non-cash consideration, and consideration when determining the transaction price. Another key concept here is if variable consideration depends on a future event, such as a performance bonus or meeting deadlines, you are permitted to include your best estimate of the variable consideration to which you will be entitled to in the transaction price. You do not have to wait for that uncertainty to resolve itself. While judgment is needed here, you are limited to an amount that is not probable of a significant reversal of this revenue when that future event does occur and the true amount is known. Step 4 is to allocate the transaction price to the performance obligations based on the amount of consideration an entity expected to be entitled to in exchange for satisfying the performance obligation. The allocation is normally based on the relative standalone selling price of each performance obligation. If a contract has only one performance obligation, then it's really quite easy. The transaction price can be attributed to that performance obligation. However, if there are two or more performance obligations, you have to allocate the transaction price to each of the performance obligations. Step 5, and I always say this is the good part, it's when the organization is able to recognize the revenue when or as performance obligations are satisfied. Performance obligations are satisfied by transferring a promised good or service to a customer. The good or service is considered transferred when or as the customer obtains control. This is a key concept here. Control is the ability to direct the use of and obtain substantially all of the benefits from that asset. A performance obligation may be satisfied over time or at a point in time. The performance obligation is satisfied if over time you will recognize revenue by measuring the process towards satisfying those performance obligations. At this time, I'll turn it back to Alejandra for polling question number 2.
Thank you, Trevor. Polling question number 2 is, will you have to bifurcate revenue streams in order to be in compliance with the new regulations? A, yes, we will have to bifurcate revenue streams. B, no, we will not have to bifurcate revenue streams. C, I do not know if we will need to or not. Please take a moment now to answer. While participants are recording their answers, I'll provide the second CPE word. The second CPE word is beach. If you want to receive CPE credit, please jot these words down because you will need them for the survey emailed following the webinar. Again, the second CPE word is beach, B-E-A-C-H. While we are waiting on the poll to close and the results to appear, please check the GRF website at www.grfcpas.com/webinars for all of our upcoming webinars and all our previous slide decks and recordings. Today's slides are already available, and the recording of today's webinars will be available following the event. With that being said, I will pass it back to Trevor.
Thank you, Alejandra. As I'm looking at the results, it does look like the majority of the responses from the attendees have answered with the response C, I do not know if we need to or not. That particular response is one that I actually was expecting to hear, and in a couple slides forthcoming, we will give you an example of how to bifurcate the revenue stream in order to properly record revenue. This particular table we've included basically as a cheat sheet for indicators useful for determining the contribution and exchange portions of membership dues. Along the left-hand column, you'll see the various indicators, and the middle column and the far right-hand column gives you the differentiators between whether or not membership dues should be considered to be a contribution or an exchange transaction. Without going into too much detail here, the biggest keys between whether or not the membership dues are deemed to be a contribution or an exchange transaction basically has to do with the benefits and whether they're provided to the general public, whether or not the member benefits are negligible versus whether or not the benefits are substantial and it's for the members of this organization or the organization as opposed to being benefits for members as well as non-members. Here you'll see we have an example for membership dues. And in response to the second question, you'll see how we will bifurcate the particular performance obligations and appropriately recognize revenue. In our example, you'll see that members pay $1,200 for annual membership, which includes 2 journals that are distributed in May and December, free admission to the annual expo, which is held in March. John Smith became a member on June 1st, 2020, and paid the annual membership fee in full. The non-for-profit has a calendar year end, and it costs $200 to produce each journal, and they charge $300 to non-members to attend the expo. Other various member benefits provided only to members are valued at $240. Here you'll see the various journal entries with the total amounts for fiscal year 2020. Under current GAAP, you'll see at June 1st of 2020, there's a debit to cash of $1,200 and a credit to deferred membership dues of $1,200. However, under the new ASU, you'll see there is also a debit to cash, just as in the current GAAP model. However, after breaking down the various performance obligations associated with those member dues, you'll see that it's broken out as follows. Contribution income of $260, deferred revenue or deferred dues of $240, deferred revenue for the journals at $400. Again, the price of the journal is valued at $200, and there's 2 of them for the year. And the deferred revenue associated with attending the expo. Again, for non-members, it was calculated to be at $300. So again, at the time cash is received under the new model or revenue recognition standard, you'll see that it's quite different from our current model. During the months of June through December, the organization under current GAAP will recognize membership dues ratably over the membership period. And basically, it's $100 a month, again, for the months of June through December, where you debit deferred revenue and you recognize membership dues revenue. Conversely, under the new revenue recognition standard, during the months of June and December, we have a debit to dues of $20 per month and dues revenue of $20 per month. Again, we're taking the deferred dues amount of $240, dividing that by 12, and appropriately applying that from deferred revenue to membership revenue, of $20 per month. In December, you can remember in our example, we have the revenue or associated with the journal, whereby we will then recognize that first journal. And you see under new GAAP, we have $200 being recognized. And under current GAAP, there's no recognition of that journal. At December 31st of 2020, we have total dues revenue of $700 under current GAAP. Again, this is for the period June through December at $100 per month over the 7-month period. Again, a total of $700. Conversely, under the new revenue recognition standard, we have contribution income of $260, which gets recognized immediately. The dues revenue of $140, again, $20 per month times 7 months, and the journal revenue of $200 for that December journal. And continuing on, the journal entries associated with the remaining portion of the membership dues for the months of January through May. Again, we are recognizing $100 per month for those 5 months. And conversely, under the new GAAP revenue recognition standard, we're recognizing $20 per month for membership dues. In March, we have the expo, at which time under the new GAAP, we will recognize the $300 associated with the expo. And in May, we will recognize that second journal of $200. At December 31st, 2020, we have total dues revenue for that period of $500. And conversely, under the new GAAP, we have dues revenue of $100, total journal revenue of $200, and total expo revenue of $300. At this time, I'll turn it back to Alejandra for polling question number 3.
Thank you, Trevor. We have come to our last polling question. Have you started identifying potential revenue streams that will be impacted? A, yes, we have started. B, no, we have not started. C, I am not sure if we have started or not. Please take a moment now to answer. While participants are recording their answers, I'll provide the third CPE word. The third and final CPE word is vacation. Again, the final CPE word is vacation. V-A-C-A-T-I-O-N. As we wait for the poll to close and the results to appear, GRF would like to thank FEA for co-hosting the webinar today. The FEA is a national affinity group for nonprofits administered and sponsored by First Republic Bank, which focuses on networking opportunities and discussing industry-related issues with local chapters in New York, Boston, San Diego, Los Angeles, San Francisco, and Portland, Oregon. The organization is intended for senior financial decision makers in the nonprofit sectors, including education, arts and culture, health, social services, foundations, and others. With that, I will pass it on to Trevor for the results of the last polling question.
Thank you, Alejandra. In taking a look at the responses, it seems that the majority of the responses have answered B, no, we have not started. Again, as Walt had mentioned, for most organizations, this particular standard would not be applicable until 2019. However, as we all know, before you know it, it'll be 2019. So we strongly urge everyone listening to this webinar to begin going through the process of developing an implementation plan for this revenue recognition standard. And for your convenience, we have provided you all with an implementation plan for Revenue 606. First and foremost, read the standard. As Walt had mentioned earlier in this webinar, the particular standard is over 700 pages, so it will take some time to go through it all. We also suggest that you attend any and all additional webinars, seminars on this very topic. Step 2, assign a staff member to become an expert. Depending on your respective organizations and various revenue streams, we suggest you also include the various departments within your organizations to also become involved with this implementation. For example, your membership department, your program department, registration departments, etc. Step 3, revisit your chart of accounts to compile a list of all revenue streams and determine which revenue streams are going to be impacted. Step 4, develop and document a position paper on each revenue stream. Basically here you will be identifying the 5-step process for how to treat those revenue streams. And 5, discuss the conclusions with your peer group. And peer group, we mean organizations similar to your respective organizations and also within your own organizations to see if everyone is on the same page and are pretty much have come to the same conclusions regarding how to treat your various revenue streams. Of the 5 steps, we believe one of the most important steps here is to include your various departments within your organizations. We believe this is the most comprehensive and best way to understand all of the performance obligations associated with recognizing the revenue appropriately. And continuing on, step 6, if a change is immaterial, if the change is not material, document it annually and discuss it with your auditor. If the change is going to materially impact your organization and its financial statements, we suggest that you definitely have it documented and also available for your auditor, because they will be using this information in order to test revenue to ensure that it's being recorded in accordance with your policies and procedures. Step 7, communicate the changes, and do this each year, because as you could imagine, the performance obligations can change. Additionally, if you do not communicate this to your entire organizations, at a minimum, we believe you should definitely communicate this to management and those charged with governance. Step 8, determine a transition plan. How is this going to be implemented and when? Step 9, develop a plan for staff training. This is important because the standard does not only impact your accounting department. And last but not least, update your policies and procedures. Your accounting manual will have to be updated accordingly. And again, as I had mentioned earlier, your auditors will be testing this and will be inquiring or asking questions regarding whether or not you've gone through these steps and properly documented and updated your policies and procedures. At this time, I'd like to go into the exposure draft that FASB has released, which slightly redefines the distinction between revenues and contributions. This particular exposure draft is called Clarifying the Scope and Accounting Guidance for Contributions Received and Contributions Made. Again, the intent here is to have similar organizations consistently and correctly present revenue and contributions in its financial statements. Here I'm going to provide you all with just a quick overview with some specific details. The changes are as follows as it relates to grants and contracts for your nonprofit organizations. The first issue is to characterize grants and similar contracts with government agencies and others as a reciprocal transaction or exchange, and therefore subject to Topic 606, or non-reciprocal transaction or contribution, and here you'll follow Topic 958. And the second issue is to distinguish between a conditional or an unconditional contribution. Here you'll see some key provisions to help identify and help clarify this issue. The differentiator between a contribution and exchange transaction is that in an exchange transaction, there has been an exchange of commensurate value, and additionally, there are reciprocal benefits flow directly between the parties to the arrangement. Conversely, a contributions show that the benefits flow to the general public rather than to the funder. One thing to note here is the type of resource provider does not matter. It can be a government agency, a private foundation, or even a corporation. And one other thing to note here as well is that federal grants could be either an exchange transaction or a contribution. Certain federal grants, there is a reciprocal benefit, so the federal government may receive something in return. Other federal awards are clearly for the benefit of the public, so you will have to look at each grant and contract closely to determine which guidance is applicable. So in step 2, after a contribution has been deemed unconditional, the entity shall consider whether the contribution is restricted on the basis of purpose or restricted to be used over a specific time period, excuse me. If the contribution is deemed to be restricted, revenue recognition is similar to what we've always done, just like before. As you know, with the Accounting Standards Update 2016-14 for presentation of the financial statements, the 3 net asset classifications have now been replaced with 2 net asset classifications: net assets with restrictions, net assets without restrictions. And again, if you have an unconditional contribution that is restricted for purpose or restricted due to time, it will be classified as net assets with restrictions. If no such restriction exists, it would be classified as net assets without restriction. So what makes a contribution conditional? Basically, there are 2 components. A donor-imposed condition must have a barrier and a right of return or a right of release. This is basically determined by the agreement. It doesn't have to specifically say there is a right of return or a right of release from obligation, but the agreement should be sufficiently clear to support that conclusion about whether that recipient is entitled to the transfer of that asset. Now, how do you determine what a barrier is? There is the inclusion of a measurable barrier if there is a specified level of service. For example, if the agreement says you must provide a certain number of meals per week, or if there's a specific outcome identified, or if there is a matching component. All of these things are indicators that there is a barrier regarding that contribution. Secondly, if there are stipulations related to the purpose of the agreement, like a specific event or activity, that will make it a barrier in the agreement. This generally excludes administrative tasks or a trivial stipulation or something unrelated to the purpose of the agreement. For example, if in the agreement there's a clause where there has to be an annual report provided in order to receive subsequent payments, that would not be considered a barrier. The annual report is deemed unrelated to the underlying purpose of the award. Third, limited discretion could indicate a barrier. If the nonprofit has limited discretion on how the transferred assets are spent, that is deemed to be a barrier regarding that award. The last indicator listed here is whether or not additional actions are required. This would be a new or existing activity that the nonprofit normally would not have undertaken, and this is usually coupled with measurable barriers. So again, some contributions may be unconditional but restricted. If the contribution is conditional, it should be accounted for as a refundable advance and hence a liability on your financial statements until the conditions have been met or waived by the donor. For your convenience, we've included a real quick chart, if you will, for your respective organizations to take a look to determine whether or not how you treat specific transactions. It's pretty self-explanatory, so I won't spend too much time here, but you'll see at the top, if the transactions in which each party directly receives commensurate value, if the answer to that is yes, it's deemed to be a reciprocal transaction and subject to topic 606. If the answer to that question is no, it's deemed to be a non-reciprocal transaction, and you apply the contribution or non-exchange guidance. Again, this is the guidance with which you've all been accustomed to in the past. Secondly, if this non-reciprocal transaction has conditions present, for example, a right of return or a barrier, if the answer to that question is no, restrictions present, for example, limited purpose or timing, if the answer to that particular question is yes, it's deemed to be unconditional and restricted. If the response to that question is unconditional and without restrictions, it's deemed to be unrestricted. Again, those two terms have been replaced with net assets with restrictions or net assets without restrictions. And going back, if the conditions present, a right of return and barrier, if the answer to that question is a yes, it's deemed to be a conditional grant or agreement, and you recognize the revenue when the condition has been met. Proposed transition approach and effective date. The proposed transition approach and effective date, so what does this apply? And it applies to all agreements entered into after the effective date and those that are existing at the effective date. It only applies to the portion of the agreement not previously recognized, so there is no prior period adjustment here. There is no restatement and no cumulative effect of the adjustment for the opening balances. A retrospective application is permitted, and the effective date of this is basically the same as revenue topic 606, The timeline on the exposure draft and the comment letters were just due, and they are supposed to be redeliberating and looking for the comments and in final ASU sometime later this year. Here you'll see we've also developed an implementation for grants and contracts. It's very similar to the one previously discussed for our revenue recognition. The first step is you want to read the FASB project update, and again, hopefully later this year, we will have a formal ASU issued. Step 2, assign a staff person to become your expert here. It's probably or advisable for that person to be the same expert from topic 606 because they're going to be looking through and determining which path of revenue recognition is going to go through. Step 3, review all grants and contracts. Again, here you're going to be determining whether or not it is an exchange transaction or a contribution. Step 4, document the decision process for each grant and contract. Hopefully, you'll have similar ones in nature, so you'll be able to follow what you've directed or decided, on the previous grants and contracts. But again, you will need to review each of those because there could be some elements in the agreement that could change your ultimate decision. Step 5, train the staff for any changes. Here is where I think it's important to bring in those again from the various departments within your organizations. You will definitely want to know the specific wording and terminology you may want to use in all future grants and contracts. And lastly, step 6, update your policies and procedures for any changes to revenue recognition. Again, you will want to update your respective accounting manuals accordingly because as you could imagine, your auditors, once they come in to perform auditing services of the financial statements, they will want to see if the organization has been recognizing revenue in accordance with the revenue recognition standards, as well as it's being properly documented in your accounting manual. At this time, I'll turn it back to Alejandra to go over any questions that the attendees may have.
Thank you, Trevor. Before we wrap up today, we want to answer a few of the questions submitted by our online participants. The first question I have is, what if you determine the membership benefits are minimal? Can you split the contribution between years if your year end doesn't coincide with the membership year to be able to have revenue in the following year?
Walt, I think I can take this one. In response to that question, the short answer is no. If your membership benefits are minimum, you would have to recognize that revenue as a contribution up front. Again, if you can remember in the example that I previously went over, that particular portion of performance obligation associated with the membership dues is being recognized immediately and recognized as a contribution. Additionally, if the membership year and your year end for the organizations are different, that may have a big effect on your organization. You will end up recognizing that up front, and then in the following year, you will not have any revenue to recognize relating to that membership fee.
Thank you, Trevor. The second question is, what is the difference between a condition and a restriction?
Well, I can take this one as well. That's a very good question, and unfortunately, it's not as clear as you would hope. Accordingly, the FASB exposure draft that's in preparation is to be specifically identifying and providing guidance on just that. However, to meet the definition of a condition, it must contain, again, a barrier and or a right of return or that of a right of release. In the old terminology, there used to be discussion of talking about a future or uncertain event. Again, this has now been replaced with this barrier concept, hopefully to reduce the diversity and how people are recognizing such transactions in its financial statements. FASB is hoping to be able to clear up any type of confusion in that matter. Donor-imposed restriction is still based on the current definition, so it includes how broad or how narrow the purpose of the agreement is and when those funds can be used for specific purposes and or over a specific time period.
All right, thank you, Trevor. And then I think we have time for one more question. If you go to the calculation of the new revenue standard and the change is not material, do you have to adopt?
Trevor, I'll take this one. You know, this is a new accounting standard, so everyone needs to adopt the standard at the applicable adoption date. However, if you go through the process and you are looking at what the dollar amount is versus what you have done in the past and it's immaterial, I think you could choose not to make that adjustment in journal entry. However, you will have to look at this each year to determine materiality. So if this is an ongoing contract or ongoing exchange transaction, you will have to look at that. You know, the auditors come in are going to be looking at this as well. And if this is immaterial and this maybe need to be disclosed on the AUC governance letter to those charged with governance, informing them that there were past audit entries relating to the revenue recognition. So it may just be easier to post the adjusting entries even though they are immaterial.
Thank you, Walt. With that, GRF and FEA would like to thank everyone for attending today's webinar. We encourage you to always check our website for upcoming events and updates at www.grfcpa.com/resources/events. If you have any additional questions after today's program, please reach out to us. Our contact information appears here. Please remember to complete the email survey that follows if you would like to earn CPE credit for attending today's webinar. Thank you again for attending and have a great day.